here. So you guys stick around. This is going to be a great interview. I'm very excited to meet Mr. Wang. Let's see if he is here with us now. And
he is a panelist now.
He is. And let's ask him to unmute.
Hello, can you hear me?
We got you,
Joseph.
Hey, thanks so much for inviting me. It's a pleasure.
Before we get
here.
started, Joseph, I want to introduce you to the founder for.
I think we just lost Dale. Dale? Or did you just lose Blake?
No, I think Dale's
dipped. No, Dale is gone. He said he has internet issues.
Well, Joseph?
Yes.
Nice to meet you. My name is Blake Morrow, and we have the Forex Analytix team is here. Steve, Ryan Littlestone, Steve Vulgaris, and Dale is hopefully he's here. If not, we're all here. So welcome to the Face webinar, and I'm going to play interim host right now while we're waiting for Dale to come back. It sounds like he is having some internet issues. So thank you for joining us. I was just telling our audience and the traders that are here on a daily basis, I was telling them how I've been following you on Twitter for a while, and
I'm back.
I'm like, man, I think you're probably one of the smartest guys that I've seen on Twitter. I love your commentary, and I'm like, we got to invite him on to the Face webinar, and then all of a sudden, Real Vision, started asking you on. I'm like, dang it, they beat us to the punch. So it's so nice to have you here. Can you tell like the traders that are listening in, a little bit about yourself and your background?
Sure. Well, first of all, thank you for inviting me, Blake. I really appreciate it, and thank you for your kind words. So I used to be a senior trader on the open markets desk, and that is the trading desk for the Fed. So what I did there was run operations. So I was a repo trader, but what you really do on the desk is you study the financial system. So you're kind of like a strategist. So what I did there was just study the banking system, the financial system, and how things all fit together. And in my view, that's a really useful way to understand the markets, especially now when so much is macro driven, particularly by central banks. And looking at some of the charts you guys here, it seems like a lot of the work you do is in currencies. So that's kind of exactly, in my view at least, one of the major drivers in currencies these past months is central bank interest rate differentials. So I think that is a useful way of understanding markets, especially the FX market. And before I was at the Fed, I was a credit analyst, and before that, I actually was an attorney. So I practiced law for a little bit, but it wasn't for me.
It's that's actually a pretty awesome, scary, and dangerous combination, I would say. Now, when you're talking about interest rate differentials, I try to explain to traders, and we do focus a lot on currencies, but we actually talk a lot about macro and what's the drivers behind the market, because I think what traders really get hung up on, and especially we deal with a lot of retail traders that are some of them have been trading around the markets for decades, others are just kind of dabbling into the markets. I think what we find is a lot of people put so much emphasis on technical analysis, but they don't put enough emphasis on the macro point of view, having the thesis, having that tailwind in your back, if you will, while you're trading the markets and trying to make some money, understanding the what is the movers. So when you talk about interest rate differentials, that's what we've always looked at as the biggest mover in the currency market. So what is for you right now? We're seeing this big divergence between what's happening with the Fed and where other central banks are playing catch up, and you have the ECB, which really is almost like non-existent at this point. What are your views as far as interest rates where they're at right now and where they're going, and is the Fed really going to follow through with what they've been warning us, especially now over the last few months? What do you think?
Yeah, these are really good questions. First, I would say that looking at the interest rate markets broadly in the past couple of months, I think it's largely driven by policy differences. Now, for FX, as you guys know, momentum and things like technicals play a role, but I think this move largely is driven by policy changes. And the most obvious candidate for that is, of course, the Bank of Japan's yen. That yen move against the dollar is just it's like a parabolic move, and it looks like it's going to continue as well.
Yeah.
So what's happening, in my view, in the FX markets are twofold. One is political and the other is CB driven. The political aspect has to do with the fact that it seems that there's a prospect of a continuing war in the Eurozone. So if you look at what the administration is doing, they're not really seeking to de-escalate. They're not really fighting ways for, let's say, Russia to back off, giving them a place to stand off. They're giving Ukraine lots of weapons. They seem to, and I think various administration officials have hinted at this, it's a way to weaken Russia. And so if that's the case, it's going to be a protracted conflict with potential of escalation. And if you have capital in Europe, then there's a very serious risk there. And so there's a lot of capital moving out of Europe into dollars. And so I think there's that one move there. And moving on to the second point, central bank differentials. It's obvious in Eurozone, like Europe is, so they're thinking of hiking rates, but the Fed is hiking much more aggressively. There's that thing there. So that's going to play a role. But the biggest interest rate differentials are between Japan and the US. So stepping back, the global bond markets are highly correlated with each other. Bonds are not so much like equities. In equities, when you can have moves in, let's say, in China, for example, equities keep falling, but in the US, equities can keep going up. They're not as interrelated, but the bond markets are, because they're viewed as globally as safe credit risk-free assets, they're highly correlated. So usually when you have bond yields moving up in the US and the Eurozone, you would expect bonds throughout the world to move up as they have been doing. Now, it would be natural for JGBs, so bonds in Japan, to also move up in tandem with the US. But they're being prevented from moving up. The Bank of Japan has a policy called yield curve control, where they're basically putting a ceiling on the 10-year JGB at 25 basis points. And whenever the Japanese bond market wants to sell off, that's to say yields go higher, you have the Bank of Japan in there basically having an unlimited bid. And if the markets can't adjust through interest rates, they have to adjust through foreign exchange. So what that means is at the margins, someone somewhere in Japan, rather than accepting, let's say, 25 basis points in their JGBs, they're moving their money outside to the treasuries or even to, let's say, French oats or Italian BTPs, things like that. And that has a negative effect on the currency. Now, what you want to keep in mind, though, is that the central bankers, they're aware of this, and there's something that they have control over, and they're permitting. It's part of their goal. So Japan, if you listen to their meeting, I think yesterday, what they're concerned about their inflation. Their inflation is too low. It's going higher because of energy, but they think that's temporary. So in order to have sustainable, let's say, inflation around 2%, they're usually below 1%. They want to be able to continue to maintain an easy policy. And part of that, of course, is trying to import inflation via weaker currencies. So it's part of their plan to do this. So when you have these interest rate differentials and you have the blessing of the central bankers, it's kind of a one-way trade. And so you just kind of go higher.
Yeah, I was gonna ask you, I mean, were you surprised? I mean, because we've seen such an outsized move in the yen just over the course of the last, obviously over the last month or 2 months or whatever it is. Are you surprised that, the Bank of Japan is still is not worried about the yen and you haven't heard anything from the Ministry of Finance? I mean, is that surprising to you, or do you kind of fall in line with the BOJ and say, I agree that they're not getting enough, they need more inflation, which I think is crazy, but anyway, but that's me personally. I was asking your opinion. What do you think?
Yeah. Oh, first of all, I just follow up on your last question. So whether the Fed will actually carry through the hikes. So that's actually not that important, because when the Fed says they're going to hike, it gets priced into the market immediately. So it's already there. Now, they may not actually realize, so the market is pricing in, let's say, 2.5 inch overnight rates by December. They might not actually get there, but it doesn't really matter, because once saying that, it's priced into the market. And so if you want to go and you actually have to borrow at let's say, in the 2-year level, that's the price you pay. Those are the rates that you pay. So it's already happened. Whether or not they actually carry through, that would just change future pricing. So,
hi, Joseph. I'm Dale Pinkert. Nice to meet you.
Hey,
I'm
Dale.
having some internet issues, but you write about the great steepening. I went over that your website, but the burning question for me and a million traders out there, is there really a plunge protection team, and were you on it?
I was on the plunge protection team, what you would call that, but our mandate was not to save the stock market.
All right. All right.
But who knows, man? Maybe Jay Powell has his own private Bloomberg terminal that he's just banging on it whenever something goes. But as far as I'm concerned, it was not done through the trading desk. So as far as I'm concerned.
All right. So then why don't we get
So wait,
so you didn't answer it.
He does have a bat phone somewhere.
All right. Well, everyone, plunge protection team. Now I think they have a bear. They have they talked about a Fed put. Now, do we have a Fed call? And the Fed wants this break to happen in the market.
Yeah, I think they do. I think they do. It's actually something that. So last week, Jay Powell was on a panel at the IMF, and the journalist actually asked him, "So, are you trying to get equity prices lower?" And he just kind of danced around it. So the way the Fed thinks about this is that when you have, let's say, a really hot market like you do today, hot as a real economy, inflation hot, what you want to do, the textbook answer, is to tighten financial conditions, right? So you want to slow the economy down. What are financial conditions? The way the Fed looks at it, there are a lot of different components to this, things like spreads, level of interest rates, things like that. But one of them is equities. So when you're hiking rates and you see equities still buoyant, that tells them that financial conditions aren't really tight yet. And if they're not really tight, then you kind of can't get to your goal of slowing down the economy to fight inflation. So having lower equities is definitely expected. And I would actually go further and actually highlight something else that I think is developing in the central banking world. So the Bank of England, one of their senior policymakers there, had a speech, I think just a couple of weeks ago. And what she mentioned was that one of the things that she's noticing is that, hiking rates doesn't seem as effective as it used to be, maybe because central banks have very large balance sheets. So there's so much liquidity in the system, maybe hiking rates is not as effective as it used to be. And if that's the case, maybe we have to hike more aggressively. And I think that's what's happening in the central banking world, because you see that in the Bank of England, but you also see that in the Fed as well, right? So suddenly we went from last year, I don't think we're going to hike rates, to now we're thinking, yeah, we're going to do it 50 basis points multiple times, right? So that's kind of going to be the playbook. We're going to have to hike aggressively, in part because they want the asset prices to go lower. And
why not match sales, Joseph? That used to be a tool for draining. Are they going to be using that tool?
So you're like shifting like an operation twist, that you would basically change the yield curve level. Let's say the shape of the yield curve, you mean?
Yeah.
Like maybe sell the front end, buy the long end. Well, yeah. I think the problem is it's just that everything is just too low. That's the issue. Okay. Yeah. But so that everything is too low, and the Fed has, if you listen to them, they don't really feel comfortable having such a large balance sheet, having so much treasuries on their portfolio. They don't feel comfortable about this because they actually don't know how it works. And you can read many people, many senior FRB presidents talk about this. They don't really understand how QE works or QT works, and so they don't feel comfortable doing it. And so they feel like they would like to be in a world where they use something that they understand, that they feel comfortable with, and that's the Fed funds rate. And so part of it is trying to get a smaller balance sheet. But also, I don't want to leave Blake's earlier question just hanging there. So about the Bank of Japan, whether or not they think that they're going to, if it's, I think I was very surprised that they let this parabolic yen move go higher. And it's strange because they have so much opportunity to push back on this, but it seems like they're okay with this. And I don't know what Kuroda has as his target internally. I'm sure. So the way that they do things, they definitely have a target. Just don't know what it is. What's more important to them, I think, is that it's not disorderly. So they don't want to go from 130 to 150 in a week, but whatever their target is, they want to get there in an orderly fashion. What I would
But we're going from 115 to 130
In zero time.
is okay.
Yeah, yeah. I mean,
I
that's just.
guess.
I mean, you don't really see moves like this, right? So
You don't.
it's just amazing. But one thing you want to keep in mind though is there is tremendous fragility in this trade. So one day, and I don't know when, maybe it's 140, maybe it's 150. One day they're going to feel like this is enough. We've got the yen to where we want to be. And when that happens, they're going to have to, stop this depreciation. The easiest way to do this is going to be to relax yield curve control. Right now, that's a 25 basis point ceiling. When they let it go, there's a potential for it to be tremendously disorderly. So the Reserve Bank of Australia also used yield curve control under 3-year during COVID. And they let it go last November, and it's kind of a mess. There's no easy way to let things like this go, and so it has the potential, one, to be volatile, but two, as I was mentioning earlier, you have global yields that are all closely connected. So if you have the 10-year JGB, let's say, go up 25 basis points suddenly, or maybe more, that's going to very quickly flow through to treasuries and the rest of the global yield curve. And so that's some potential for volatility in rates across the world. And I mean, what do you think would happen to stocks or other risk assets if woke up one day and 10 years suddenly up 20 basis points? It's a volatile thing. So I don't know when that will happen. I just imagine that one day the market is going to take the yen and carry it too far, and then the BOJ will step in and put a stop to it.
Joseph, this is Steve Vulgaridis. Based on the multiple things you've told us already, I have a very, very basic question, and it is the following. You used to work for the Fed for several years, so you don't only have the view of the outsider, as we all do, but you also have the view of the insider.
Yep.
Do you think that these institutions, with the role they have taken for themselves / given to them by politicians that don't want to face expedited issues that have to do with the economy, are nowadays, with their current role, I reiterate, useful? Do they bring more good on the table having to do with guiding the global economy, or they actually do more harm in the long run?
I think they do more harm in the long run, and it's for exactly the reason that you mentioned. So these guys, the government is going to be short-sighted, right? So they're going to do things that help them now. And I think the biggest problem that I think central banks caused is that they made it easy for governments to engage in deficit spending that is just out of control.
Profligate, yeah.
Exactly.
They subsidized it.
Subsidized it enormously. I mean, so the Fed has $5 trillion in treasuries on their balance sheet, right? And so the US Treasury looks at this and be like, hey, we can just spend infinitely, and it's no problem because the interest rates are low. And that leads to a lot of distortions in the economy, where you have, first of all, you have tremendous spending to, let's say, special interest groups and things that are not good for the public, but good for the politicians. But you also get the public addicted to free money because they think that they can just issue this debt and spend forever. Now, that would not be the case if the Fed was not there to subsidize them, right? Sooner or later, they would be rates would be higher, and there'd be more inflation. So I think it distorted the incentives. So
what do you think can actually bring an end to this era? I mean, and is there any way for this to happen in an orderly fashion?
So for things to be unwound orderly, I think so. The way that I view things is that it's not so much the Fed is complicit, but the biggest driver of things like, let's say, inflation or potential disorder is what's happening on the federal level, because you're basically printing treasuries and buying goods and services at an unsustainable rate, right? And the only way to stop that is if you raise taxes, let's say reduce deficit spending, live within your means, so to speak, for a little bit. And that's just really hard to do in a world where you have periodic election cycles. So if you listen to what the Biden administration is talking about, they want to forgive everyone's student loans, right? That's like over $1 trillion of free money that's going to be put into the economy. It's going to be highly inflationary. You can think of it as a tax cut to everyone who borrowed student loans, because now they don't have to make that student loan payment anymore. They have more disposable income. So you have incentives like that, and it's hard to ever stop it, because thus far there have been no consequences. But it looks like consequences are appearing in the form of higher inflation. So I don't think there's an orderly way to do this.
I also have a weird question, which doesn't directly involve you, but being in the Fed, I always had a big question mark in my mind. Are journalists complicit to this? I know it's a weird question, but I'm gonna explain what I mean. I have watched several press conferences, right? And it makes you curious. Where do these people come from? I mean, they almost never ask the obvious, difficult questions. Are they vetted before they get there?
So I'm not familiar enough with that process to know if they're vetted. But I will say this one thing though. So I know some journalists, and the way that if you are a journalist and you want to have good stories and be close to the Fed, you have to have a relationship with them, right? You have to be friends with them. Now, if you're asking things that are critical with them, then you're not going to get access. So there's an incentive there to say good things and be in play along. But another thing that I would note is that occasionally, when I was at the Fed, we do read stories from journalists that we think are really weird and not fair and just nonsensical. There's that too. So it's not super clear to me. I'm sure some journalists are just playing along as mouthpieces for the Fed, but not all of them.
Okay, Blake.
Yeah, that's an interesting question. But Joseph, I say your insights are awesome, and thank you so much for just taking the time and spending it with our community. Just helping us understand what really happens at the Fed and kind of some of the moving parts that we all deal with as traders. So I want to ask you just a couple of questions as we wrap up. Do you think, and I want to kind of go back to the original question about Fed raising rates. Do you think that the Fed is anywhere near like their forecast? Do you think they're overshooting right now, or do you think rates are actually going to continue higher for some time? What are your thoughts from where expectations are now to where you think reality might be moving forward?
I think that the front to medium term is priced well. So I think the market right now is thinking that the Fed would probably go to a terminal rate of a bit over 3%. That, at least for now, I think that's fine. What I think that the market is not pricing as well is the longer dated rates. Let's say 10-year are just below 3%. That doesn't seem right to me. So I guess I'd give you a bit background. So I don't know. Everyone comes from a different background. So, and
Sure.
Some of you may know this, but the way that let's say the 2 to 5 year is priced, it's just basically priced completely off anticipation of Fed actions. And the way that this is enforced is that the knowledge that the Fed has complete control over the overnight rate. So, for example, if the Fed says the overnight rate, I'm going to have it to be 1% from here today until the next 3 years, then if you are someone who is lending in the markets, you can say, well, I can lend overnight to the Fed every day at 1%, or I can lend someone for a 3-year term, right? But the two have to be comparable. So 3-year rates, term rates become 1%, because I can either just lend to the Fed every day overnight, or I can lend for 3 years and get the same price. So the market's understanding of, one, the Fed has very strong control over the overnight rates, and two, how they will guide the overnight rates for the next 5 years. It's more easy to anticipate, and so you can have whatever is between 1 to 5 year as very, very much as what the Fed market thinks the Fed would do. And I think what they're anticipating is probably right. Now, beyond that, let's say 5 to 30 year, it's a lot harder for the market to know what the Fed will be doing in, let's say, 10 years, because really,
Right.
who knows, right? So a lot of that really just comes down to supply and demand. I think that the market is mispricing, let's say, 10 years, 10, 20, 30s, because we're going to have a lot of supply in that market coming online. And if you look at the trajectory of how the government conducts its spending, it just kind of spends and borrows, right? So it basically issues more debt at a very high rate, and looks like it'll do that forever. So there's going to be a lot more supply coming online, and I suspect then that the market rates will have to go higher to find more people to buy that. So I think that's probably mispriced in my view. So I think that there's a lot of reasons for this. I mean, if you were like a central banker, then you'll say, oh, the market has low interest rates in the future because they think that central banks are super responsible. And so we have great credibility, inflation will be stable, and voila, Mark, that's why the 2 years at 3%.
Right.
If you ask some, like, let's say some macro people, they'll be like, yeah, because we have aging demographics. So of course, growth will be slow. So obviously, longer term rates. Yeah, I don't really believe any of that stuff because I think what happens oftentimes is price leads sentiment, right? So you have a 3-year, 10-year yield at, let's say, a bit below 3%, and people make up stories to justify. You see that in equity markets all the time. I think it's just some mispricing. With respect to those former two arguments, I mean, inflation is it's not really all up to the Fed to be honest. It used to be so when you have a world, let's say 100 years ago, where everything is private. Now, I say that because private sector is interest rate sensitive. So if you're the Fed and you raise rates, then obviously all the private sector borrowers, people who have actual businesses, they react to that. Maybe they cut down their economic activity a bit so that inflation gets under control. But we're moving into a world where the government plays a very, very large role in the economy. And the government is not sensitive to interest rates. They just don't care. So, rates could be like 10% and Congress would not care, what they want to do. They just borrow and spend, right? So if you're living...
Sorry to interrupt, Joseph, but is that indeed the case? Meaning, for example, with the debt maturity of the US being having a durability of average duration of what is it, 3, 4, 5 years,
Yeah,
something like that. Isn't it going to start biting very, very much once they start having to roll over all that debt with 5%, 6%, 7%, because it's going to be making the need to borrow a lot bigger, a lot faster. Isn't that going to become a political issue at some point?
it could be, and I hope it does. But it's so far, just looking for the past few years, it just doesn't seem that way, right? So,
yeah, but the past few years, we did still have super low interest rates. Now we seem to be changing from that, right?
So there used to be a culture where there would be one party saying that we got to shrink the government and have small spending. I don't get the sense that people care about that anymore. And you even have some part of the economic world would advocate something like MMT, saying it doesn't matter. And you have President Biden basically saying, yeah, well, if we have inflation, we shouldn't cut back on spending. What we should do is we should spend more and increase the supply. So I hope you're right that we do have, let's say, some cultural change such that becomes more concerned about the spending, but I don't see it yet. And it seems to me that we're moving.
I think it's going to be forced upon government sooner rather than later. Reality is going to be harsh.
The reality only manifests itself in inflation. It will never manifest itself in rates because the central bank can always buy it all and let's say peg the yield curve if they want.
Yeah, I was just gonna go there and okay, but anyway, that's it. Gosh, Joseph, I know you've been really lenient with your time, and I want to say I appreciate having you here. I'd love to actually do a deep dive on some of these topics on Trader Summit if you're available sometime.
Sure. I mean, I'm Happy to speak with you all, and thank you very much for inviting me. I enjoyed meeting all you.
Yeah, thank you, Joseph. And
Dale's still here. Okay.
yeah, and for people that were watching or watch a video later, you could follow Joseph at FedGuy12. And Joseph has a great website, fedguy.com. And great to have you as part of our intelligence gathering here. And
Hey traders, this is Blake Morrow with Forex Analytics. Thanks for stopping by our YouTube channel. Don't forget to like these videos, share them, and subscribe to our channel so you don't miss any of the content that we provide here for free. Thanks for stopping by. I'll see you in the next video.